Welcome to Investors Insights. Our topic today is Your Worries, Our Focus. I am joined by my distinguished colleagues, Trey Booth, Bobby Norman, and Adam Van Zandt, and thrilled to bring you information today regarding what's taking place in the economy, the markets, and how it can impact your portfolio in relation to your financial blueprint. So also know that the conversations that we have here, debates, discussions, we will continue those always throughout the week so that you can stay informed. And as we navigate through all the conversations and data that's coming at us left and right, there's been a big discussion in our organization about our clients and the feedback that they give us. And several have voiced about their worries and concerns, what they're hearing in the news. Bobby, you did a great job this morning kind of summarizing that and giving people a reason why they need to focus on other things. So talk about that.
Yeah, Greg, I've spoken with numerous clients in the past few days about worries they have in the world and in the market. And look, there's a lot going on in the world right now. Middle East uncertainty, inflation scares, COVID. We saw Hurricane Ida come through where we saw oil firms slash output by 91% in the Gulf. So watching oil prices carefully. We're seeing mixed economic reports. But at the end of the day, it's important as ever for us to stay focused on the biggest factors of what's helping the market continuously grind higher. It's important to remember the Federal Reserve is still accommodative and corporations are still seeing strong earnings growth. So as you can see in this chart, U.S. corporate profits are still seeing highs as core capital orders and shipments hit new highs. So if you're talking with friends or colleagues about the concerns of the world, show them this chart. Corporate America is very healthy right now. So, we also saw second quarter GDP revised higher. We're seeing third quarter GDP tracking around 5.7%. That's solid growth. So again, it's important to stay focused. Stay focused on two of the primary drivers of the market. And as of today, they're both tailwinds for the market.
Well, and you're absolutely right, Bobby. And if people go back and listen to our previous vlogs, we've emphasized the importance of the earnings and what's taking place there and that they really need to stay focused on it. And the other thing we've talked about is the Fed. We've talked about that the Fed is so far winning in all aspects. And Trey, you brought in additional information, great insight with Chairman Powell last week as to what he was saying. So talk about that and how it ties to what Bobby just said.
That's right. Yep. The biggest fear that the market has is that the accommodated Fed will reduce their accommodation too soon before the normal economy, which is corporate earnings, catches up. And so what we heard out of the Federal Reserve Chairman on Friday in the virtual Jackson Hole Summit was that this is a long way away. And what he was very clear about is separating a reduction in purchases of assets from higher rates. So it doesn't just go from one directly to the other, which gives the Fed a lot of decision-making and time to decide, has the economy gotten to the point where it can stand on its own 2 feet without Fed tapering, really supporting a lot of the markets. And so seeing those earnings growth is very important. Seeing it continue as the Fed reduces bond buying and potentially increases rate, that is a multi-year process now. So back in 2013, the last time the Fed reduced bond buying, they were buying at that point $85 billion a month in treasuries and mortgages. Right now, the Fed is buying $120 billion a month. That the tapering in 2013 took just under a year. So at the same pace that the Fed starts at the end of the year tapering, which again is still a long way away. We have a lot of data between now and then. We're looking at 2023 before the Fed even is done buying new assets. That's a long way away. And then beyond that, the Fed has time to decide whether or not they raise rates. Previously, it took the Fed 2 years to go from stopping buying bonds to increasing interest rates. And that's going from easy policy to hard policy. And what that means is that the Fed is saying, we want to reduce economic growth. Right now, they are still stimulating and trying to push economic growth forward. $120 billion a month is going to continue at least to the end of the year. And so what will cause that to speed up or extend is the data. The Fed is looking closely at corporate America, that information that Bobby just went over, and then also the jobs market. We've talked about this ever since really the great crisis of 2020, where the Fed came in. They're focused on jobs, and we'll get another data point on jobs each month. And this month's August job data will come out on Friday. The last 2 months have been phenomenal. Over 1 million new jobs created in the last 2 months, each, not total, each. And this month is looking to be around 500,000. That'll be a very big data point to see how we're going in terms of job creation going forward. And I think the Fed has gotten a lot of push to be less accommodative because of the phenomenal 2 month jobs data we've had. If that doesn't hold up, we may see a longer timeline on Fed accommodation, which at the end of the day is very positive for markets.
Well, and Trey, let me interject here from the standpoint, this Fed focusing on jobs is kind of unique from past Feds.
Exactly. The tradition,
a huge positive.
Exactly. Traditionally, the Fed is looking very closely at inflation and jobs. And what we've seen is that they let the inflation tail wag the overall policy dog. And then when you see a little bit of inflation, they raise rates too soon before job recoveries come back. And this Fed has made it clear they're looking at jobs. They think the individual is the most important part of the economy. Economists agree or disagree. They may be right or wrong, but they have been very clear with that. So that's why we're so hyper-focused on the jobs data. And while the Fed may say they're going to potentially taper at the end of the year, they're still buying the bonds. And that, at the end of the day, supply and demand in the short run pushes prices higher. And if you have $120 billion a month coming into the financial markets, that is a huge demand driver and likely will keep prices elevated.
Yeah, and if corporate earnings are going up, they can hire more people.
Absolutely.
They can improve the technology, the efficiencies for those workers as well to do better on their jobs. So it's a great combination that Bobby and you have put together there on your information. And then Adam, I'm coming at you because we've gotten a lot of great feedback on the technical analysis, which ties into the fundamental analysis that we just got from Trey and Bobby. So with that, talk to us where the markets are from a technical analysis standpoint, support levels and resistance levels.
Exactly. And to your point, Greg, Bobby and Trey gave some great fundamental data. So on the technical side, I do want to talk about the markets. We saw a large boost at the end of the last week, and the S&P closed over 4,500, 4,509 to be accurate. And then we have a new resistance level now of 4,530 with a new support level of 4,480. We want to talk about this because about a month ago, we gave an end of the year resistance level. That was 4,500. Now, it is important to keep in mind that when we go over these vlogs, we're typically giving a short-term analysis. So we do want to see that 4,500 kind of stay above that level before we determine whether we're having a bullish pattern or not in the markets. And that's why it's important to look at this technical analysis and correlate it with the fundamental analysis as well.
Yeah, well, it gives people an idea of what we're looking at as we're navigating through the markets and matching that up with their financial blueprints. And let me say this, folks, as viewers, we greatly appreciate you. We appreciate the way you forward this to family and colleagues at your work or your social gatherings. It means a lot to us. And we also appreciate the feedback, just like we said about your concerns and worries, as to also the information that we provide and how you find it invaluable in what we're providing. So we want to make sure that we're working and striving every day here at Five Plan Partners to make sure that your life is better, richer, fuller, and that your portfolios are in relation to your financial blueprints, and we're tracking where you want to be in your financial goals. We hope you have a great week. We're reaching out to our clients in Louisiana. We are hurting for the state of Louisiana at this time, and we want to make sure everybody's safe. And just don't hesitate to ever call us, email us. We want your feedback, and we always, on this vlog, want to provide you valuable information. Have a great week as we head into Labor Day weekend. We'll talk soon. Thanks.